So let's talk about if you were utilizing that mitigation block and that fair value gap and waiting for the market to go to what? A short-term premium. Well, wait a minute, ICT. You said that this here is equilibrium in the overnight dealing range. So as long as it's below this, we're weak, right? But look inside this price leg here, from that low all the way up to the high here. There's several price swings. From this low, looking back, forgetting this one here because that's just a small little reaction. We've already mentioned the purpose of why that would be used, which would be trailed stop losses on shorts. Above it would be buy stops. Above that, the 15-minute fair value gap, which is this blue one here, and it falls below equilibrium of the overnight dealing range. From this high, going to the left, higher than that high, where's the next immediate swing high? You can't use this one because it's lower than that high. That's not a swing high. That's a swing high, right here. So if we use that frame of reference there, this movement up to that fair value gap here, within this dealing range, which is also in what? A discount still relative to the low here and the overnight range. Now, I know some of you that are brand new, this is completely confusing to you. Trust me, the core content, go through those lessons where I'm talking about price swings and looking at how prices fractal, price swings within price swings. This is how you build narrative. This is how you do it, okay? It's not just simply plot an indicator or an indicator that's supposedly has my name plastered all over it. It's not gonna do this kind of work for you folks. Okay, I know there's folks out there that are making things for TradingView and other, platforms, the ICT fair value gap and the ICT new week opening gap indicators. You're going to have lipstick on your chart, but unless you know how to use it, it's going to do nothing for you. It's going to confuse you. You're going to have more things than I have on my chart. If you use all those other indicators, there's going to be fair value gaps all up in here. I'm not looking at them. I have a process. I have to go through a process of what I'm walking you through here, which is the logic, how the algorithm is going to refer to the specific fair value gaps. It's not just because there's a fair value gap, price is going to go there. That's what separates me from everybody else that's trying to be like me, to sell mentorships and courses and such. And I hate sounding like I'm a hater, because I'm not hating. I love the fact that people are gravitating to my concepts, but a lot of them are overzealous and they're trying to be educators when they don't know what they're doing yet. And you're actually hurting your own image, and you're also presenting misinformation about my concepts that you don't know. Like, you don't know it yet. But this fair value gap is in a premium relative to the dealing range from this swing high to that low. Now think about what I was outlining earlier. The market has had a big move overnight. We do not go in chasing the market lower because it went down overnight. If we want to get short, we have to do what? At least allow the market to do what? Trade to a premium. So how do we identify a premium? We have to look at the price leg that we moved from or within recently, which is this movement down. I showed you, let me show another fib so that we can keep it in context of what I'm showing you here. So from this high to that low here, this 50% level is equilibrium. That swing high happens to be where? Right at equilibrium of the overnight range. Then we have a fair value gap on the 15-minute time frame here, because I'm looking at a 5-minute chart. Remember, we dropped down. It traded up into that fair value gap. At the same time, it traded up into a 15-minute mitigation block. And the logic was, we want to see, does the market reprice lower from there? First objective would be what? Trading down into the wick of here. Then I said if we go through that, we have the order block. And then here. How could you use that as a model? How could you use that as if you wanted to trade this and be short, because now we've watched buy stops that would be trailed here, because as the market went lower, traders are going to do what? They're going to want to jam their stop loss. And when it started to break a new low here, buy stops will be placed right there. The market does what? It trades up into a short-term premium relative to this high, to that low. And we're still in a discount market relative to the range overnight. So it's indicating weakness. So you have several things there in your favor. You did wait for it to go to a short-term premium. You did go to a inefficiency, and it's at an area where it created what? A mitigation. So because this range here is indicating overnight, that range, we haven't even made it back up to equilibrium. So we're still heavy. We knocked out buy stops. The market routed up to a fair value gap and mitigation. Consequent correction of this wick, target 1, target 2, order block, and then you could get this as another objective, which is not done so. And now we're working off of this order block